All right.
Welcome, everybody. It's good to see a lot of familiar faces. For those of you who don't know me, of course, my name is Joe Pastore, and I'm really excited that you could all join us today. I want to tell you a bit about my company, and when I say my company, I mean Iman, who's my partner. He's here with us, and he'll join in a little later. The name of the company is called PEco Capital, and it's really a different type of company because it's a company that actually cares about its clients as well as the planet. So we offer unique, sustainable investment strategies. Some people call it ESG, some people call it impact, and Iman will give a very good differentiating explanation a little later. But what we do is really a little different, and we'll come back to that a little bit later. But for those of you who know me, you know that I like to begin meetings with quotes. So here's my quote for the day, and it kind of does apply to the investment industry. The number one reason that people fail in life is because they listen to their friends, family, and neighbors. And you know who said that? It was Napoleon Hill, and that was almost 100 years ago. But it is still relevant today. Everyone's like, oh no, my friend said this, and my aunt said this, and yeah, that's not the way to invest. But anyway, PEco Capital's mission is to provide custom-tailored investment solutions, but we're very concerned and we focus on superior risk-return characteristics. Plus, we try to deliver a high level of service because we want to deliver a unique client experience that not only helps clients meet their investment goals, but also helps them sleep at night. Because I know we've all had investments that are, risky, we lost money. So we're trying to manage this in such a way where we can help mitigate that risk. Now, sustainable investing in general focuses on companies that are well run. They do what's right for the environment, their employees, as well as their clients. And while sustainable investing, it's a great idea, and it's truly its time has come. But we also realize that as much as investors, care about the planet, if they don't make a reasonable return, they're not going to remain clients very long. So we know there has to be that right balance. So to be successful in this business, you have to have a process and a strategy that mitigates risk under any market conditions. Now, in 2010, Bruce Willis starred in a movie called Red. Maybe some of you have seen it. It also featured Richard Dreyfuss and John Malkovich. And during the movie, Richard Dreyfuss gave us this quote, which I think is extremely relevant, and it might help illustrate what sustainable impact investing is all about. And he said, "We have a long-standing commitment to humanitarian causes because exemplary corporate citizenship is our highest goal. As a company with global reach and global interests, we also have global responsibilities." Now, sometimes I get asked if this commitment to ethical behavior affects the bottom line. And my answer is always the same. Yes, it makes it stronger. So I think that quote kind of sums up what impact investing is really all about. It's about not only caring for the planet and caring for the people, but doing the right thing, because companies that tend to do this tend to be the stronger companies. Now, at PEco Capital, Iman and I are first and foremost equity managers. We have combined experience of over 60 years. We started working together over 20 years ago at Wilshire Associates, which some of you may have heard of. And there we learned how to manage institutional money. We managed some of the largest pension funds in the world, including CalPERS, Koch Industries, Raytheon, IBM, Royal Dutch Shell, just to mention a couple of them. Now, we learned the process for managing institutional money from one of the best in the industry, our old boss, Tom Stevens, who actually invited, but I don't think he's here. But he has been, and he continues to be the manager for a lot of these major pension funds for the last 35 years. And he's been quite successful at matching or beating their respective benchmarks in general. So that's what we're kind of about. Now, at PEco Capital, not only we adopted that same process that the big pension funds get, but we also understand the discipline it takes to stick with the process and not go for the quick bucks that many investors are chasing today, investing in names like, GameStop and AMC because, they heard about it on Reddit. Not only do their fundamentals not support the price, but they make no sense whatsoever. And, in the old days, we used to say hope is not an investment strategy. Here, we're going to amend that today to say hope nor investment decisions based on Reddit chatter are effective in long term. And they're just not. More people end up losing money following these trends than making money. Now, a lot of investors, even money managers, they use words like price and value interchangeably. And Warren Buffett talks about this, and he said, price is what you pay, but value is what you get. So speaking of Warren, I want to share a couple of other favorite quotes of mine that kind of illustrate our investing style and our value bias. This one you probably heard before. Only when the tide goes out, you discover who's been swimming naked. When the market goes up, everyone looks like an investing genius. It's only when things go sour, you see who really has a good long-term strategy. Very important, and exactly where we are. Couple more. The best thing that happens to us is when a great company gets into temporary trouble. We want to buy them when they're on the operating table. This statement kind of sums up value investing. Here's another one you probably heard, but people usually omit one word in here that is kind of important. We simply attempt to be fearful when others are greedy and be greedy only when others are fearful. People like to leave out the only, and it actually changes that a bit. And last one is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So once again, all these statements from the great Warren Buffett, they all revolve around value investing, and that's sort of what we're about. Now, being an experienced portfolio manager is important, and I worked with both Merrill Lynch and Morgan Stanley for almost 20 years. So there I learned how to properly protect a client's portfolio, and to do that, you need non-correlated asset classes as part of your overall strategy. You can't just invest in stocks. To mitigate risk, clients need a variety of investment options, not only equities, and especially when markets get volatile. It's very difficult for the stock market to produce consistent returns. Now, the traditional asset allocation models, with large amounts of fixed income or bonds, they've really become a lot less effective over the last 12 years, and mostly because we've been in an artificially low interest rate environment. Artificially low interest rates lead to inflated asset prices, and we've seen that both in the stock market and the real estate market. And more importantly, nothing lasts forever, which is more important now than ever before to incorporate a variety of strategies into your portfolio with the best risk-return characteristics and a low correlation to equity markets. This is how you're going to protect yourself when things go wrong. Like I said, for the last year, it's been easy to make money when the market's going straight up. But when things go wrong, once again, as Warren said, that's when you see who doesn't really have a strategy. So at Platinum Eco Capital, we have two principal themes: sustainable investing and the inclusion of alternatives, which are less correlated to the equity market. This enables us to bring together the best of both worlds: world-class asset management, the process and the discipline, as well as non or minimally correlated asset classes like private equity, IPOs, real estate, hedge funds, even time deposits. Now, I have a long history and a lot of experience in the investment industry, but the reality is nobody can be great at everything. So in order to deliver a variety of strategies that best meet client needs, objectives, it's important to have other managers. So in-house, and we'll talk about all of this in a bit, we manage option strategies, we manage equities, but we form strategic alliances outside of Platinum Eco Capital with providers like MarketX for IPOs and private equity, and they're going to share a few words with us in a few minutes. Also, iCapital, Armada, True Risk Capital for hedge funds, Oakhurst for structured option strategies, Haven Realty for real estate, and ZeroCap for time deposits and digital currency transactions. We're even looking into adding Verde for life settlements, which provides a stable source of income with low risk. So despite my youthful appearance, I've been in this industry for over 35 years as an investment advisor, hedge fund manager, trader, senior portfolio manager, CEO, and analyst. And I've seen firsthand through different market cycles that you need a variety of investment strategies that incorporate non-correlated assets if you're going to weather the turbulent markets. So that's why I'm really excited to share what we do at Platinum Eco Capital. And I want to tell you a little bit more about it, because here we've got the depth, platform, experience, process, and discipline to deliver alpha and minimize risk regardless whether the bulls or bears are running. So without further ado, I'm going to try to share my screen here so we can show you a couple of slides that kind of give you a little more detail. So let me just second share and hope nobody's left in the waiting room, because if they are, they're going to be there for a while now. All right, so can everybody see this?
Yes.
Yes.
Okay.
Yes.
So
Good.
Platinum Eco Capital, investment management for sustainable future. That's kind of our motto, our logo. If any of you are familiar with Carmel, that's where this picture was taken. I took it, and that's why I like it. But I think it serves us well. So who are we? We're an RIA firm based in LA. We're specializing in sustainable investing in both public and private markets. Iman and I run the show here. We have a full suite of investment products, a variety of strategies that can help meet all clients' objectives. We'll tailor portfolios just for your particular needs, your retirement, your risk tolerance, all of those things. Every client we work with has to do a risk tolerance questionnaire so we know where you're coming from. Once again, we really believe in the impact in sustainable investing, and we'll get into that detail in a minute. But clean tech, alternative energy, these are all important parts of our strategies. We also use structured option strategies, things that have defined outcomes with less risk. So this is the kind of thing that, we're going to be involved in. My background, aside from being a founding partner of Platinum Eco Capital, I worked with Hercules Investments. A lot of you probably know that. I'm also a CRPC and a CDFA. CRPC is Chartered Retirement Planning Counselor, and CDFA is Certified Divorce Financial Analyst. I was a senior portfolio manager at Morgan and Merrill for 17 years. I was a hedge fund manager for Wilshire Associates, managing over $2 billion of hedge fund money, once again for some of the largest pension funds in the world, CalPERS, IBM, Koch Industry, etc. Before that, I worked for American Express Bank International, where I ran the trading desk, managing over $200 million for high net worth non-US residents. I started out my career way back in 1983 at Oppenheimer as a broker's assistant. I've got an MBA in finance from Pace University in New York. And I have my undergraduate degrees in psychology with a minor in accounting from NYU. I've also written over 10 books, many of them about investing, some about, career, how to start a company, digital marketing, social media, even have one on quotes. Anyway, Iman, why don't you tell them about yourself?
Sure. Hi, everyone. Thanks for making time for us. As Joe mentioned, actually, Joe was my boss at Wilshire Associates back in the early 2000s. So we've known each other for so many years. I have over 20 years experience in institutional risk management, and I've managed over $9 billion in domestic and international equities. I got the bulk of my experience at Los Angeles Capital Management under Tom Stevens, a firm that manages around $30 billion in assets, institutional assets, as we speak. I have my grad and MBA from UCLA, and also a master's in economics from BU.
All right. Okay. So why Platinum Eco Capital? Why are you going to be better off with us than somewhere else? What is it that we do differently? As we sort of talked about a little, is the process. And we'll get more detailed on this in a bit, but we're using the same process that the big pension funds use for stock selection and constructing portfolios. So if you were to go to these people, you'd have to go in with, $1 billion or so. You're getting the exact same management here for a lot less cost, and they wouldn't talk to, small investors anyway. The other thing is we're offering a solutions-based product mix We've got a variety of strategies. Once again, structured products that help define risk and define your outcome, private equity, IPOs, hedge funds, real estate, and of course, traditional portfolio management. Experience, we average over 25 years. Diversification, each portfolio has a minimum of 30 companies, plus there's risk capital allocated to make sure we don't get too far away from any of our respective benchmarks. Rebalancing, of course, we do that quarterly. Financial planning, we want to make sure that we're going to be in line with what you need. This isn't about us. This is about delivering what you need for your retirement, for your goals, for buying a new house, for whatever. Trading, both of us have extensive trading experience, decades. We do use asset allocation models. I don't so much use the traditional ones because once again, I'm going to have a lot of alternative investments in there. But absolutely, we look at your risk profile and that helps us design a portfolio for you. Some of the investment product areas we get involved in, the traditional stuff, normal equities, individual stocks, but we also use mutual funds and ETFs for smaller clients, private equity and IPOs, options. For the alternatives, we have structured option strategies, hedge funds, real estate, even the structured life stuff. And finally, yes, of course, we'll do time deposits and money market accounts for people who need them. The big four alternative asset classes, hedge funds, private equity, real estate, and structured options, all four of them, we can represent you, and we've got a pretty deep platform. So I think it's exciting, and it's going to be able to take care of whatever you need. Now, the investment strategies, these are mostly, these top 9 are actual strategies we manage. Sustainable impact, disruptors, renewable energy, e-commerce, FANG Plus, large, mid, small cap, EFA, large international, emerging markets, and then of course have your fixed income, your cash equivalents, and once again, the alternatives. So private equity and IPOs, we use a company called MarketX Ventures because obviously we can't do everything ourselves. And for MarketX Ventures, we actually have Dylan and Catherine on the line with us. So I'm going to let them take over for a couple of minutes and tell them a little bit about what they do.
Thanks so much for the kind introduction, Joe. My name is Dylan Graff. I'm an investor relations associate at MarketX. Prior to MarketX, I was a consultant for several years. I worked with Goldman Sachs and Deutsche Bank. And I found my way into MarketX, wanting to be closer to my clients and develop long-term relationships with them from a sales perspective and provide access to them into the pre-IPO market space. So a bit about MarketX. We are a fintech platform and venture firm focused on late-stage pre-IPO technology companies. We've worked with companies such as Airbnb, SpaceX, Rubrik, and we continue to work with SpaceX actually. And what we've seen really is that private companies are staying private longer. And this creates higher demand for liquidity from existing shareholders, early investors, early employees. And we really found a demand on the investor side too, on the buy side for these types of companies, buying shares of these types of companies. So the company was founded 7 years ago. We've done over 22 deals. We do work in both a deal by deal basis, and we also have the MarketX Special Opportunities Fund, which is a diversified rolling fund in which we invest in our 50 most profitable pre-IPO companies. I would be more than happy to connect with everyone on this call one-on-one, walk you through our pipeline. As you can see on this slide, we have some of the companies we've worked with in the past: Grab, Uber, Gojek, Flexport. We have excellent relationships with many of these companies, early founders, C-level execs. And we work closely with other VC firms as well, such as Sequoia, Tiger Global, in order to find a match between sell-side and buy. And our main mission statement is to provide access to a broader range of investors other than the top 1% of traditional institutional investors. So, with that, Joe, thank you so much for the kind introduction, and I look forward to connecting with you all one-on-one.
Hi, everyone. Can you guys hear me well?
Yes.
Great. Yeah, I just wanted to say hi. I know Dylan just gave an overview of our firm. I'm Catherine, the founder of MarketX Ventures. Love to give you guys a little brief background as well. As Dylan mentioned, this company was created 7 years ago. We have offices in LA, San Francisco, Hong Kong, Singapore, and we also expanded to Europe and also Middle East. So we look at companies that are in a high-tech growth stage, pre-IPO in all continents. And with our previous deal exposure, as you can see here, we have a lot of US and Asia IPO and pre-IPO candidates. So for this, love to give everyone an overview about next gen transportation, fintech, vertical SaaS, which are the 3 areas we spend a lot of time on. On top of that, love to also talk about our MX50, which is basically an easier way for people to get exposure to top companies like Airbnb, SpaceX before they go public. But the 50 names around the world. So love to, please let us know if you have any questions. And Joe, feel free to, give us any questions that might relate to private equity or venture capital. Thanks again for having us here.
Great, thank you for that. And just so everybody knows, MarketX does a presentation every Tuesday at 5 o'clock Pacific time. So there you can see what their pipeline is for the week, what the current deals are. And because these are current deals, they're not usually around very long, usually just have a couple of weeks. So I encourage all of you, anyone who's interested, contact me afterwards and we'll get you hooked up. So get you on an email invitation to their webinars every Tuesday at 5. And you also have them Thursdays at 9?
Thursdays at 8 a.m.
Yeah,
Thursdays at 8 a.m. Pacific time.
We're trying to cater to both East Coast and West Coast time. So, Tuesday 5 p.m. and Thursday 8. Just so everyone here kind of understands, we have 2 set of opportunities. One is basically these individual single name, what I call special purpose funds. So, for example, we created a fund to invest in Robinhood. So you're just investing one company. The minimum is usually, 100 to 100K versus, we also have the fund, which is called MX50. With that, you're investing a typical venture capital fund that gets exposure to all top names in US, Asia, elsewhere. So those are the 2 different products that we have, which is why, Joe was talking about our weekly webinar that's focused on going over the top deals.
All right, well, great. Thank you for that. So moving along. Next, I want to talk about structured option strategies. Now, what is that? Clients want to protect their investments. If we think that the market's going to go up, but we're not willing to risk losing a lot of money, there's a way to structure it using treasuries, ETFs, or just options so you can protect the downside either completely or partially. I'll give you the simple example, and I've been doing this for a long time. A 0 coupon bond is a bond you buy below par. Where normal bonds, say you buy at 100, it pays you interest. A 0 coupon bond, you buy at a discount, say at 95, and it matures at 100 after whatever, a period of time. If you couple an instrument like that with an option, you're guaranteed to get your money back. So once again, you buy it at 95, you buy options for $5. The treasury matures at 100. So that's how you get your principal back. If the option strategy works out, great. If it doesn't, you're still guaranteed your principal. Now that's a very simplistic example. Usually there's a combination of different kinds of options, calls, puts, both long and short. They don't always use treasuries at all. But the point is, there are strategies that you can protect the downside either fully or partially and still have exposure to the upside. So you're changing that risk reward relationship. And that's how, portfolios outperform the market over time. You always want less risk. So this is a complicated page, but I'm just going to draw your attention to this first line here. And this particular strategy is called, SPY killer. And SPY, of course, stands for the S&P. For this particular one, the investment is $207,000. It's 31 months. You have 24% protection on the downside and unlimited upside. Now, because we're in a low interest rate environment, To get full protection on the downside, you'd need to go out 5 to 7 years. So rather than do that, people realize like, well, if you can protect 25% of it or whatever, that works. Now we can tailor these strategies for you if you have a longer time frame, a shorter time frame, if you're more risk averse, less risk averse. But this is a better way than just playing options where either you're right or you're wrong. Here, we're always altering that risk-reward relationship in your favor. Here I have an explanation of what all these strategies are. So if any of you ask me for a copy of the presentation afterwards, I can get this to you. We, of course, do your traditional option strategies, covered call writing, put writing. We'll put a long short position on anything. And I also do something called profit scheduler. And what that is many stocks demonstrate a pricing pattern over time. For example, John Deere stock between February and March goes up 10%, in 19 out of the last 20 years. It's not unusual that stocks exhibit this pattern behavior. And oftentimes it comes around, when they release earnings and things like that. But we've done, or I haven't done it, but I have the research for all these companies where every month there's going to be a couple of strategies that, 95% of the time they go up or down between, a certain period of time. So that's what profit schedule is all about. Once again, one more way to decrease risk on a portfolio and help us all make money. Okay, alternatives. Our major alternative provider is iCapital, and iCapital gives us access to some of the major hedge funds, private equity, private credit funds out there. This last one over here, Millennium, in my opinion, is one of the best hedge funds out there. And we've got about 30 or 40 of these, but you can see, who's eligible for it. You have to be qualified. Do you get a K1? What's the minimum investment? So pretty much any major hedge fund out there, we can get you into for $100,000 minimum, where Millennium, if you were to go directly to them, the minimum is $25 million. So that's beyond the reach for most investors. So it's important to have a partner like iCapital to work with to be able to deliver hedge funds to you for relatively small amounts. Now, almost always you're going to have to be either qualified or accredited. So if you're not, maybe this is not the right investment, but for people who are, once again, we've got the depth and we have access to the good stuff. All right. Next, real estate. We partner up with Haven Realty, among others, and Haven Realty has a great program, and they're targeting a 15 to 18% IRR. And the way the program works is they're taking advantage of the flight from people from the cities to the suburbs. Now, this has been going on before COVID, but COVID's really exacerbated it. Now, if you're leaving the city and going to a suburb, chances are you may not want to buy a house because you just don't know if you're going to stay. So what they do is they buy developments before they're done. They end up renting everything out, and they usually try to match the price of renting a house with that of an apartment. And if you can have a house or apartment for the same price, what are you going to do? I mean, of course, you're going to take the house. So the program's been doing really well. They're currently in the middle of a $10 million capital raise. It's probably only going to be open for another month or two. But once again, this is a great non-correlated asset class. Real estate's relatively stable. 15 to 18% is a pretty high IRR. So one more way we're going to try to diversify your portfolio. Now I'm going to turn it over to Iman. He's going to talk about the equity investment process. And I just want to state first that so far, everything I've talked about, I'll refer to as kind of the dessert. For alternative investments, you never want to be more than 30% invested in the portfolio. So you need the meat and potatoes of your portfolio. They're going to be equities. And to do that, we're going to do it in-house. We've been doing it for years. And Iman's going to go through the process. So Iman, all yours.
Great. Thank you, Joe. So our investment process when it comes to equities is we use a bottom-up stock selection process with an emphasis on both traditional and non-traditional financial factors. So, and I think that will become more clear as we talk about it. So, but besides that, risk control is also very important in portfolio construction, and we diversify holdings between different industry groups and limit size positions. So So what do we mean by traditional financial factors? So we look for, when we analyze a company to put in our portfolios to invest in, we look for the following characteristics: improving fundamentals, quality balance sheet, positive sentiment, relative value. And at the end, we also look at high ESG characteristics within that company. We integrate ESG risks into every investment process and every strategy that we offer here at Platinum. So if we could go to the next slide. So what is ESG? And most of you all know what ESG is, but let me just summarize it in my own words. So ESG is a metric to measure a company's risks outside the traditional financial accounting framework. So this is a non-traditional financial factors that we're referring to. So ESG measures the intangibles of a company, which actually based on research explains most of a company's value. So through ESG analysis of a company, you can determine how sustainable or competitive the company is. So looking at the three pillars of E, S, and G, the E, the environmental pillar, looks at a company's management and use of its resources. And if the company is trying to minimize externalities to the environment resulting from its operations. So that's the E. The S part, the social factor, looks for companies' treatment of its employees through such things as compensation, professional development, health and safety measures. And this has a major impact on the ability to attract and retain the most talented employees. And then finally, the G, the governance. In general, a good governance of a company, a good governance leads to a greater transparency and more efficient use of capital. So if we go to the next slide, Joe. So what are the benefits of a high ESG company? What is the benefits of integrating ESG into your investment process? So here we're kind of illustrating how a company, high ESG company, results into being more profitable and more competitive going forward, right? So in general, a high ESG company has a lower cost of capital. It has less litigations against it and less regulatory obstacles, and attracts and retains the most talented employees because of its treatment of employees, and also the alignment of interests between the management and shareholders allows the firm to move and be competitive and work for the benefit of its shareholders and its stakeholders. So overall, a portfolio of high ESG characteristic company has a better risk return profile. So the question is, what is really the difference between ESG and thematic investing? And the next slide will address that. So as we talked about ESG and ESG integration into the investment process, but what is thematic investing? And thematic investing is investing in long-term trends, so-called mega trends, such as climate change and clean energy. So here are some of the thematic strategies that we offer here at Platinum: sustainable investing, disruptors, renewable energy, e-commerce, and FANG Plus. So if we could go to the next slide, please. And the next, perfect. So here's a performance slide of 3 strategies that I'm currently managing. And the purpose of showing you these slides is to illustrate the risk return profiles of how a typical portfolio looks like. Here, we want to emphasize that all the equity strategies are risk controlled. There's a risk budget around them. And here you can see that the 3 portfolios that I currently manage have a risk of around 3% versus the benchmark. And performance has been good lately, and the information ratio as a result is close to 1, which is basically return over risk. So risk control is important in everything that we do here at Platinum. Let me just talk about one of the thematic funds, or the Sustainable Impact Fund. The objective of this fund is to invest in companies that are in the forefront of sustainable global economy, while at the same time providing attractive return. It's a thematic approach, and what we mean is that the universe of companies that we initially look at the themes fall within these specific categories. These themes, climate, health, empowerment, and others such as efficient city infrastructure and cybersecurity. So on average, the portfolio holds around 30 to 40 names, and again, risk controlled of around 10% versus the tracking error. We never reach that 10%, but we manage it to be less than 10%. And we have roughly a turnover around 60% in the portfolio. If we could move on to the next slide, perfect. And here is, again, we did touch on this a little bit earlier, but here is the investment process on the Sustainable Impact Fund. And the process is a fundamental approach to investing. Again, we look at a quality balance sheet and quality cash flow statements. The quality of a cash flow statement is important to us. Improving fundamentals or improving earnings and valuation and market sentiment is also important in that company. And we incorporate or integrate ESG analysis into this process as well, making sure that at the end of the day, we are buying companies with high ESG characteristics. And finally, the end resulting portfolio, and not just of the Sustainable Impact Fund, but everything else is a diversified risk control portfolio. Here is just an illustration of how this particular fund looks like in terms of its top 10 holdings. And it's a variety of holdings that addresses climate change, such as Sunrun and Universal Display, to one of the themes, which is aging and demographics, which is addressed here in this top 10 holdings by Tower REITs, as well as the health peak properties, and obviously waste management could fall under the clean energy, as well as the smart city infrastructure, efficient city infrastructure theme. But here is just basically illustration of how a top 10 holdings of such a fund looks like. We have, in the next couple of slides, we also have a top 10 holdings of the other strategies, and I won't go over it because I'm sure it's going to be boring to a lot of people, but if you guys have any questions afterwards, I'm more than happy to answer any questions that you may have.
Yeah, so basically, aside from the Sustainable Impact Fund, we've got about 10 other funds. Once again, we don't want to go through each one because they're managed the same way. We use the same process to do it, but we do want you to know they are available. So with that, that's pretty much everything I wanted to go through today. So I want to open it up for questions, see what you guys think, what's on your mind, and how we could be of assistance to you. Anybody have any questions for us?
Hey, Joe, Iman, you guys did a great job. And Kathy, Dylan, great to see you guys. I was wondering, given that there's a systematic process that we're doing to choose things, how often is that reviewed for a client? And what kind of parameters are in place in terms of like exit strategies? Is there stops? Is there what could the client expect?
Well, for the equity strategies, obviously everything is completely liquid. Clients can get out whenever they want. They're rebalanced on a quarterly basis. More often, if necessary, if you have a change of management or something comes up where you need to reevaluate a company. But assuming everything is stable, rebalancing is quarterly. Equity strategies go on for as long as it's consistent with the client's financial plan and their status. For the alternatives, it's a little different story because some of them have maturities, some of them have lockup periods. But once again, we try to keep, with the exception of maybe the private equity and the IPOs and some of the hedge funds, everything else is pretty liquid. And that's the way we end the real estate. Now, it's not horrible having a non-liquid asset in your portfolio. In fact, a lot of times the non-liquid assets perform better because people don't touch them. You know, one of the slides we had here earlier, which we didn't really get into, but public markets tend to underperform private markets, and by a wide margin, because, you know, people put the money in there, they leave it there. This is before, you know, a company goes public, before people get crazy about, oh, I want to get the IPO that's hot. So a lot of times, especially with the pre-IPO market, the names that you don't know are often the best performers. Those are the companies that are put together right, but they don't have all the buzz. You know, if you try to get involved in SpaceX right now, it's very expensive, or Discord.
Yeah.
But
100% second, Joe, just chiming in here.
please.
So, you know, we've invested in a bunch of names that people have not heard of. Like, for example, back in the day, when we looked at Relativity, which is a small rocket company, they basically, the idea is that going forward, people really care about privacy. If you want to have all your information stay with you, then there should be small satellites in sky, right? So they ride on top of the Dragon, you know, flight with SpaceX, but at the time nobody have heard of Relativity. We came to LA, you know, El Segundo, look at the company, and there was Series B, like a tiny little warehouse, right? We invested, and that company has so far 10x, and we haven't touched that investment for several years. So, you know, a lot of the times when we look at companies in that category, or something like Rubrik, which, you know, if you invested last year, it was probably single 2-3 billion valuation. Now it's like going for, you know, 10 billion IPO, right? So for companies that you want to hold on for at least a year or two in the private markets, those are the highest growth. Granted, there's also liquidity options for pre-IPO companies, which is kind of like a, you know, known secret a lot of people don't talk about, right? So, you know, we have exchange market that allows people to sell their pre-IPO shares. So for example, with Rubrik, we invested, and now there's actually a buyer for 10 million of Rubrik shares at 45, which is like 2.5x our original investment. So for the LPs that invest in our funds, they can actually sell their pre-IPO shares through these secondary transactions even after they buy it. It's basically what we call an LP interest transfer. So that's also possible, just not a lot of people know about it. So, you know, for pre-IPO deals, we recommend for people to hold at least 1 to 2 years. But, you know, if there is a need for liquidity, we can also conduct that. So that's also something, you know, hopefully that can be helpful to you.
Great, thank you for that. And thank you for the question, Anthony. Who else has more questions? And it could be on any of this stuff. I mean, once again, the equity stuff we manage in-house, Iman takes care of all that. The alternatives, some of it we do in-house, some of it we don't. Not everything is liquid, but that's not a bad thing. Once again, we're never going to put more than 30% of anybody's portfolio in anything that's not liquid or not traditional. So we understand balancing things out, but, you know, we want to make sure we're protecting you on the downside and trying to mitigate that risk. I mean, that's what we're all about.
Hey Joe, on the structured options, could you clarify, like in that first example, if you can go back to that screen, it was showing like a 26% downside protection or something like that?
That's correct.
So does that mean you're covered up until that point on the downside to 26%, or
right. If the market or this particular index was down, say 27%, you would be down 1%.
1%. Okay, that's what I thought, but I just wanted to clarify. I wasn't sure.
Yeah. I mean, I think these structured option strategies are great. We did a lot of them at Morgan and Merrill Lynch, because this is where you really can control the downside. Now, unfortunately, because interest rates are so low, they either have to be longer term, or you're not going to get 100% downside protection. But like I said, most people are okay with that. For a 2-year investment, if you're protecting me for 25% downside, that's a pretty good bet. And also, if you look over here in the asset, the minimum column, the minimums are based on the price of the options. So these first couple are $200,000. But if you look at these others, you know, 22,000, 33,000, 41,000, it's not, there's no artificial minimum. It's really totally based on the price of the options. So I highly recommend this. It's, once again, anytime I can get better than a one-to-one risk reward relationship, I'm lowering the risk of your overall portfolio, we're going to outperform in the long run. So that's what we're really trying to do here. Either things with accelerated risk and accelerated return with equal risk, or same return and less risk. These are the kind of assets we want to combine with your portfolio, your strategies to overall get you to where you need to go in a less risky way. Other questions? Thoughts, comments, yeah buts? All right, well, if there are no more questions, I want to thank you all for joining us today. Feel free to call me, email me. My phone is 310-493-0044. Or if you were invited by an advisor, they'll have a way to get in touch with us. You can also email me at joe@platinumecocapital.com. And if you have any other questions that you think of afterwards, we're happy to take care of that. But thank you all for your time. It's great seeing you, great meeting you, some of you for the first time. And I look forward to working with you in the future.
Mm-hmm.
So I hope everybody
Thanks, Joe.
Yeah.
Thanks, Joe and
Thank you all.
Iman.
Thank you.
Thanks, Joe.
Thanks, Danny, Eric, and everyone else. Thank you.
Thank you.
Thank you.
Thank you.
Bye-bye.
Have a great weekend, everybody.